Imagine you buy this beautiful house, right? The foundation is totally solid. The roof is brand new. I mean, everything just looks perfect.
Right, the absolute dream home.
Exactly.
Yeah.
But way down in the basement, hidden behind some drywall where you can't see it, there's a tiny, silent leak in a pipe.
Oh, those are the worst.
They really are.
Yeah.
And it's so small you don't even notice the drop in water pressure. Your monthly water bill goes up by, I don't know, maybe $1 or $2, so
Yeah.
you just completely ignore it.
Yeah, you wouldn't even think twice about $1.
Right. But over 10, 20, 30 years, that slow, silent drip just completely rots out the floorboards, it weakens the support beams, and eventually it costs you hundreds of thousands of dollars to fix.
It really is the ultimate invisible threat. Because, the damage doesn't happen overnight, so it entirely escapes our immediate attention. We are naturally wired to react to sudden floods, not to microscopic drips.
Exactly. And welcome to today's deep dive, where we are investigating a silent leak that might be happening right now in your own financial basement. We are talking about investment fund fees.
Yes, a massive topic.
Specifically, we're looking at how these tiny, almost imperceptible fractions of a percent could actually be draining hundreds of thousands of dollars from your future wealth.
It is honestly one of the most consequential yet completely overlooked aspects of building long-term financial security. People just do not pay attention to it.
They really don't. And we have a fantastic stack of sources guiding us today to help you see this. We are pulling fresh data from Bankrate's 2026 Index Fund Rankings. We're combing through the SEC's investor bulletins and analyzing a ton of Morningstar data.
Which is really the gold standard for this kind of performance data.
Definitely. We also have some really fascinating academic research from UC Davis and, of course, the classic foundational analyses from John Bogle on the actual arithmetic of investment expenses.
Bogle's work is just essential here. It provides a really comprehensive look at what is actually happening to your money behind the scenes, far away from all those glossy marketing brochures.
For sure. So our mission today is simple but critical for you. We want to uncover exactly how those tiny fractions of a percent impact a portfolio over 10, 20, and 30 years.
And really show the math behind it.
Right. We are going to equip you with the knowledge to spot and stop paying for these invisible costs so you can actually keep the money that your money makes. Okay, let's unpack this. Before we can calculate the damage of the leak, we need to establish what these fees look like on the surface, right? We need to talk about the expense ratio.
Right, the expense ratio. So this is essentially the sticker price of owning a mutual fund or an exchange-traded fund, an ETF.
The price of admission, basically.
Exactly. It is an annual fee, and it's expressed as a percentage of your total investment in that fund. And, ostensibly, it covers the management, the administration, and the marketing of the fund itself.
I always think of it like a mandatory subscription fee on your own money.
That's a great way to put it.
But wait, I have to play devil's advocate here for a second because 1% just sounds like a rounding error. I mean, if I go out to dinner and tip 20% instead of 21%, I don't notice the difference. The waiter barely notices.
Sure. In everyday life, it's nothing.
Right. So why should you care about a tiny fraction of a percent when we're talking about market returns that can organically swing 10 or 20% up or down in a single year?
Well, it is a completely natural reaction to frame it that way. We are conditioned to think of 1% as totally negligible in our everyday consumer transactions.
Yeah, it's just pennies to us.
But to understand why it matters so much in investing, we first have to look at the massive spectrum of what funds actually charge. Because believe me, not all fees are created equal. Let's pull the data from Bankrate and Saxo to see just how wide this gap really is.
Let's do it. What are we looking at on the really low end?
At the absolute low-cost end of the spectrum, so we're talking under 0.10%, you find passively managed index funds.
Okay, the passive ones.
Yeah, these are funds that just track a major market index, like the S&P 500, and they just use automated algorithms to do it. Because they aren't paying a huge team of expensive analysts to manually pick and choose stocks, their internal costs are incredibly low.
Makes sense. Computers are cheaper than Wall Street guys.
Exactly. For example, the Vanguard S&P 500 ETF, ticker symbol VOO, charges an expense ratio of just 0.03%.
Wait, 0.03%. So let me do the math. That's just $3 a year for every $10,000 you have invested, right?
That's it, $3, and Charles Schwab pushes it even lower. Their SWPPX fund sits at an incredibly low 0.02%.
Wow. $2.
Yeah, the SPDR S&P 500 ETF, known as SPY, is slightly higher but still very competitive at 0.095%. And Fidelity even offers a fund called the Zero Large Cap Index, ticker FNILX, that literally charges 0%. absolutely nothing.
Zero. Literally free. Okay, so that is the baseline. What does the middle of the road look like?
So the medium cost tier sits right around 0.50%. This is often the asset-weighted average for a lot of equity mutual funds that might have slight proprietary variations from a pure index.
Okay, so maybe they tweak the formula a bit.
Right, or ETFs that track more specific, slightly more complex themes like emerging markets or specific commodities, things that take a tiny bit more oversight.
Okay, so 0.5%. Still sounds relatively harmless on paper. But then we get to the high-cost funds.
Right. The high-cost funds are generally your actively managed equity funds. This is where human managers are actively buying and selling stocks on a daily basis, trying their hardest to beat the broader market.
The classic stock pickers.
Exactly. And the average unweighted expense ratio for these funds sits at about 1.12%.
Over a full percent.
Yes. And if you get into specialized sector-specific funds or hedge funds, that number can easily cross the 2% mark.
Okay, so we have a spectrum from literally 0% all the way up to 2% or more, which brings me right back to my initial pushback. Going from 0.03% to 1.12%, it still just sounds like a penny-pinching argument for the frugal investor. Does a 1% difference actually ruin your life?
What's fascinating here is that this expense ratio doesn't operate like a flat tax or a one-time sales tax at a cash register. It is a compounding penalty.
A compounding penalty. I like that phrase.
Yeah, think about how compound interest works in your favor, right? Your money makes money, and then that new money makes even more money.
The snowball effect.
Exactly. The fund fee does the exact opposite of that snowball. It doesn't just take a slice of the money you have today. It permanently removes the seed capital that would have generated tomorrow's growth.
Oh, wow.
Every single dollar taken out in fees this year is a dollar that cannot compound for you for the next 29 years.
So it is stealing your compounding snowball while it's still small, preventing it from gathering mass down the hill.
That's exactly what's happening.
Let's look at the IBF data to really put some hard numbers to this, because the math gets brutal quickly when you stretch it out. We will look at a $100,000 initial investment, and we'll assume it grows at a standard 7% gross return every year.
A very realistic scenario.
Right. And we will contrast a super low 0.10% fee against the standard active management 1.00% fee.
Let's run the timeline. After 10 years, your $100,000 in the low-cost 0.10% fund has grown to $194,884.
Okay, so nearly doubled in a decade. Great.
But in the 1% fund, it only grows to $179,085.
Okay, so that's a gap of roughly $15,000 after a decade. That stings, but I can see someone rationalizing it by saying, well, I had a professional manager personally watching over my money for 10 years. 15 grand is the cost of doing business.
People do rationalize it exactly like that. But pushing it to 20 years really changes the picture. At 20 years, the low-cost fund reaches $379,799.
Almost 400 grand.
Yeah, but the 1% fund only reaches $320,714.
Whoa, the gap just accelerated drastically. It went from a $15,000 difference to over $59,000.
And here's where the tyranny of compounding costs truly reveals itself. At 30 years, that low-cost 0.10% fund skyrockets to $740,169.
Nearly $750,000. And the 1% fund?
It lags far, far behind at $574,349.
165 grand. That is an entire mortgage payoff, just completely evaporated by a 1% fee.
That is exactly what the arithmetic dictates. In those later years, the 1% isn't just taking 1% of your initial 100 grand.
Right, because the pile is bigger.
Exactly. It is taking 1% of $500,000 year after year, completely destroying the late-stage compounding curve. You are basically forced to forfeit over 22% of your potential ending wealth over 30 years simply by paying a 1% fee.
And it gets even heavier if you are adding money over time, like most people do. There's an example from Forbes in our sources that perfectly illustrates a standard career trajectory.
Oh, this one is eye-opening.
It really is.
Yeah.
Imagine you save $1,000 a month over a 40-year career. If you get a 9.7% return, which is historically aligned with an 80-20 stock bond split, you end up with $5.8 million.
A fantastic multi-generational nest egg.
Truly. But if you drop that return by just 1% to account for your fund fee, so you bring it down from 9.7 to 8.7%, your final number drops to $4.3 million.
It's just staggering.
That 1% fee doesn't just cost you a fraction. It costs you $1.5 million. It takes 25% of your total life's wealth. So what does this all mean? It means you are literally giving up years of your retirement income, maybe a vacation home or your grandkids' college tuition, and you're handing it directly to your fund manager.
It is a devastating wealth transfer that happens entirely in the background. And honestly, as alarming as that 1% or 1.12% expense ratio is, it is only part of the story.
Wait, really? Only part of it. If the visible 1% fee takes a quarter of your wealth, what happens when we uncover the fees that aren't printed on the label?
This is where we get into the invisible iceberg.
The invisible iceberg. Okay, let me use an analogy here for you listening. Buying a mutual fund with an expense ratio is kind of like buying a budget airline ticket. You
Right.
see the base fare, say $49, and you think, what a steal.
Right. I'm going to Florida for 50 bucks.
Exactly. That $49 is your expense ratio. But you get to the airport, and they hit you with a $50 carry-on baggage fee, a $25 seat selection fee, a $10 fee just to print your boarding pass. Suddenly, your $49 ticket costs $134. The base fare was just the bait.
That parallel holds up perfectly. Actively managed funds have these all-in investment expenses that are buried deep in the prospectus, or sometimes they're not disclosed as a neat little percentage at all.
John Bogle, the late founder of Vanguard, and researchers from UC Davis have done some incredible work quantifying this iceberg, starting with trading costs.
Right, because active fund managers are constantly buying and selling stocks within the fund to try and beat the market. Every time they make a trade, they incur brokerage commissions, market impact costs, and bid-ask spreads.
Market impact alone is massive. Think about it. If a multi-billion-dollar fund decides to buy a huge block of a mid-cap stock, the sheer size of their order pushes the price of the stock up while they're actively buying it.
Because of the sudden demand. Exactly. They are essentially driving the price up against themselves, creating a massive hidden cost.
And we should quickly explain the bid-ask spread, too. Think of the bid-ask spread like the currency exchange counter at the airport. They always buy your dollars for slightly less than they sell them for, right?
Always a little haircut.
Yeah. The market makers taking the trade take a tiny, invisible cut of every single stock transaction. When a fund manager is trading hundreds of millions of dollars a day, those tiny cuts become a canyon.
Absolutely. And the UC Davis study actually put a hard number on this. They looked at 1,800 funds over an 11-year period and found that these invisible trading costs averaged 1.44% annually.
Wait, the invisible trading costs were actually higher than the visible expense ratio?
Yes, they often are. Now, John Bogle was a bit more conservative in his estimations. He estimated this drag at roughly 0.50% a year, but either way, it is a massive additional anchor on your returns.
So if we take the 1.12% visible fee, add Bogle's conservative 0.50% trading cost, we are already at 1.62%.
No, we're not done.
Of course not. So if constant trading drains returns through spreads and impact, what if a manager just sits on the cash? What if they play it completely safe and hold a large cash reserve to handle investor withdrawals? Does that solve the problem?
No, because that introduces the second hidden cost cash drag. Actively managed mutual funds have to keep a portion of their assets in liquid cash, usually around 5%, just to handle daily redemptions from investors who want to cash out.
Okay.
But cash doesn't grow in the market. If you have a $1 million portfolio, $50,000 of it is just sitting there completely idle, missing out on all the market gains. Bogle calculated that this cash drag reduces your overall annual return by about 0.15%.
So the fund manager is essentially holding back part of my army from going into battle just in case someone wants to go home early.
That's exactly what it is.
Okay, so that brings us to 1.77%. And there is one more monster hiding under the bed, right? Tax inefficiencies.
Yes. This is perhaps the most insidious hidden cost for investors holding active funds in standard taxable brokerage accounts.
I have to share this story from the Fundamental Wealth Source because it perfectly encapsulates the danger here. In 2021, there was a major legacy fund provider that decided to change the mandate of several of their portfolios.
A totally internal decision by the company.
Right. And because of this internal strategic shift, the fund manager started manually selling off highly appreciated assets from within the fund.
And under standard tax law, when a mutual fund realizes a capital gain internally, it doesn't just pay the tax itself, it has to pass that tax burden directly on to the shareholders.
Yes. And they had a client with $500,000 invested in this fund. Without warning, the fund distributed a massive capital gain. This client was hit with a $100,000 taxable capital gain event for the year. And here's the kicker. The client hadn't sold a single share themselves. They were just holding the fund.
It is an absolute nightmare scenario. You are entirely at the mercy of the fund manager's trading decisions. For a retiree, a sudden 100 grand phantom income spike can push them into a higher tax bracket, cause them to lose senior drug plan benefits, and trigger clawbacks on their Social Security.
Just brutal. So let's tally up the true cost of this budget airline ticket. We start with a 1.12% expense ratio. We add Bogle's 0.50% transaction costs. We add the 0.15% cash drag. And let's say there's an amortized sales load or advisor fee of about 0.50%, which is incredibly common in the industry.
Extremely common. So summing all of that up, the active fund isn't costing you 1%, it is actually costing you 2.27% a year in total drag.
Over a 40-year investing lifetime, what does that 2.27% drag look like compared to a passive index fund?
Vogle's arithmetic shows that when you account for all of these invisible costs, the low-cost index fund creates 65% more wealth for a retirement investor than the actively managed fund. You get 65% more wealth just by avoiding the frictional costs.
This raises an important question. If you are paying an all-in cost of over 2% a year, are you at least getting what you pay for?
And that is the core defense of the active management industry. They argue that their high fees pay for top-tier analysts, proprietary research, and brilliant managers who can spot economic trends before the broader market does.
Which makes sense on the surface. In almost every other area of life, paying a premium price gets you a premium product.
Exactly.
If I pay $100,000 for a car, I expect it to perform vastly better than a $20,000 car. If I hire an expensive defense lawyer, I expect a better defense. So it is completely logical for investors to assume that a fund charging 2% will absolutely crush a passive computer algorithm charging 0.03%.
It is a logical consumer assumption, sure, but in the financial markets, it is empirically false.
Here's where it gets really interesting. We transition from the theory of fees to the cold, hard reality of performance.
Let's look at the data from Morningstar, the premier mutual fund rating agency. They ran a massive study to see if they could find any variable that reliably predicted future fund performance. They tested everything.
They really dug in.
They did. They looked at the manager's tenure, the size of the fund, the historical track record, and even their own famous star ratings.
What did they find?
None of it worked consistently. The only reliable predictor of future success across every asset class and every time period tested was a low expense ratio.
Wow.
Cheap funds win. It was the only metric with actual predictive power.
It completely upends traditional consumer logic. And the S&P Global SPVA scorecard backs this up with brutal clarity. They found that over a 10-year period, 89% of large-cap active funds actually underperform the S&P 500 index.
89%.
Nearly 9 out of 10 highly paid, expertly trained professionals could not beat a mindless index that just holds all the stocks in the market.
Yeah.
How is that possible? Are these managers just bad at their jobs?
Yeah. Not at all. Many of these managers are incredibly smart, dedicated professionals with access to the best data in the world. The problem isn't their skill. The problem is the arithmetic.
Wait, let me think about this. If the active manager is dragging that 2.27% total cost we calculated earlier, they aren't just trying to beat the market.
Right.
If the S&P goes up 10% in a year, my cheap index fund gives me roughly 9.97%. The active manager has to generate a gross return of over 12.2% just to break even with my cheap fund.
Exactly. They are starting 50 yards behind the index fund before the starting gun even fires. In highly efficient competitive markets, finding an edge that generates an extra 2.27% return year after year is statistically almost impossible.
It's just too high a hurdle.
Yeah. They might do it for 1 year or even 3 years. But over a 20 or 30-year investing lifetime, the compounding weight of those fees guarantees that the vast majority of active managers will lose to the passive index.
It is like trying to win a marathon while carrying a 30-pound backpack. You might be the best runner in the world, but the guy running with no backpack is going to beat you over 26 miles.
The SPVA and Morningstar data prove that the backpack is simply too heavy. No one can carry it forever.
Man, we have covered a lot of ground today. We unmasked the visible expense ratio and saw that it's just the tip of the iceberg. We look at the compounding math, where a 1% fee can literally devour a quarter of your life's savings.
Which is terrifying.
It really is. We dragged the invisible fees out into the light, the trading costs, the cash drag, those nasty surprise tax bills, and we completely debunked the myth that high prices in finance equal high returns.
The evidence overwhelmingly points in one direction. Controlling your costs is the single most effective way to guarantee a larger portfolio in retirement. You can't control the market, but you can control your fees.
And this means the power is entirely in your hands. You don't need to be a stock-picking genius. You just need to be a relentless fee cutter. Take a look at your employer 401k portal. Providers often intentionally obscure the expense ratio behind multiple clicks.
Well, they definitely bury it.
They do. So look for a PDF document called Plan Documents or Fund Facts. Run your current funds through FADNet's free Fund Analyzer tool online. Look at what you are actually paying.
And if you see you're paying over 0.50% or 1%, you should seriously consider consolidating your investments into low-cost, broad market index funds that charge under 0.10%.
Keep it cheap.
Exactly. That simple action ensures your money is compounding for your future, not funding a Wall Street manager's bonus.
Just say no to the fees. But before we wrap up, I want to leave you with a brand new concept to chew on. We saw this in the Saxo source material, and it takes this whole low-cost philosophy to its absolute logical extreme. Direct indexing.
Oh, direct indexing. It is an intriguing frontier right now, because even a Vanguard ETF charging 0.03% is still technically a fund, right? It is still a middleman structure.
Right. But with modern technology and fractional share trading, you can bypass the fund structure entirely. Instead of buying a fund that holds the 500 stocks of the S&P 500, a direct indexing software program simply buys the individual fractional shares of all 500 companies directly in your own brokerage account.
And the software automatically manages the weightings for you. Because you own the underlying stocks yourself rather than shares of a mutual fund, it entirely eliminates the mutual fund structure.
Which takes your expense ratio down to absolute zero.
Zero expense ratio, zero hidden fund trading costs, and you have total control over your tax strategy.
Oh, right, because if one stock drops, the software can harvest that specific tax loss for you, which is something a mutual fund simply cannot do.
It's a game changer. The landscape is shifting heavily in favor of the informed investor. The tools are out there to completely eliminate these wealth-draining leaks.
Bringing us right back to our house. If you knew there was a pipe dripping in your basement, slowly rotting away your foundation and costing you $165 grand, you wouldn't ignore it. You would grab a wrench, march down those stairs, and tighten that valve today.
Absolutely. Your portfolio is your financial foundation. Check your pipes. Stop the leak.
It is time to keep what's yours. Thank you so much for joining us on this deep dive into wealth building and the hidden mechanics of the financial industry. Until next time, keep digging, keep questioning, and keep your fees as close to zero as humanly possible.